All right, so I think we're going to get started now. And so, welcome to our February Revenue Roundtable. This is on our Great Ohio Tax Report. We put this out very recently, I believe, in the last week. So, this presentation covers parts of the report, but also provides some additional commentary on some of the research. I do highly recommend that you read the report afterwards. There is going to be a QR code for it at the end, and it'll also be shared out in the resources. But I think this is a great time just to kind of walk you through what we found and provide space for folks to just ask any questions as well. Kate, is it okay to go to the next slide? So some of you may have read our past Great Ohio Tax Shift report. Some of you might be a bit newer to it. The Great Ohio Tax Shift report series regularly examines how major policy changes or tax policy changes enacted by Ohio lawmakers since 2005 have required Ohio families with the lowest incomes to pay more, allowed the wealthy to pay less, and reduce resources that the state needs to ensure the prosperity of its residents. And I want to start by discussing the sum of these cuts. How much revenue are we losing a year as a result of these cuts? And that is $17 billion of lost revenue a year. And this is undeniably a large number, but it needs to be put into context. And we can do that by comparing it with figures from the last budget, revenue raisers, and what we spent that revenue on. And that'll be the next slide. So this is a snapshot of two tables from the budget in brief, published, I believe, by the LSC following the budget that just passed. And so these two tables show where the GRF money comes from and then where it goes. And I really quickly want to note that GRF revenue comes from sales and use taxes, personal income tax, and other sales receipts, plus federal grants. Property taxes, the focus of our last revenue roundtable, does not go to the GRF. That revenue stays local, going to local government, schools, libraries, mental health services, et cetera. The other thing you might be wondering before we dive in a bit further are what are other state receipts? So that includes things like the commercial activity tax, foreign insurance tax, public utility excise tax, and national gas consumption tax. So that's just a little bit in terms of what that is. Looking at the first table, we can go through every row for sales and use, personal income tax, other state receipts, and even the federal grants. And we can see that that $17 billion a year that we are losing exceeds the amount that any of these sources are bringing in any of the 4 years that this table looks at. And so it is not an insignificant amount. But the even more impactful side of this conversation is shown in Table 2. Table 2 highlights what we are paying for using GRF funds. And this matters because if we only focus on the numbers rather than the services that affect people, we lose the narrative about why this revenue loss matters, what we lack because we don't have the revenue to support it. And one of the things we can zoom in on is K through 12 education. Some may remember from the last revenue roundtable on property taxes that a report last year from Fleeter and Browning concluded that Ohio dropped from 35th in the nation in state share from K through 12 revenue in 2002 to 45th in 2023. And that's part of the reason that there's a greater strain on property taxes. So it's alarming that the amount lost, that $17 billion, is more than double the $11.6 billion in general revenue funds that Ohio appropriated for K through 12 education in fiscal year 2026. That's a lot to digest, and you might be wondering, okay, well, do these cuts at least help everyday Ohioans, or who do these cuts benefit? And we can look at that in our next slide. So this table looks at the combined impact of Ohio's major legislation since 2005. And it's split into kind of 5 quintiles when looking at impact. So the lowest quintile is the Ohioans earning under $26,000. The Ohioans in the second quintile are those earning between $26,000 and $50,200. Those in the middle are earning $50,200 to $84,500. The fourth 20% is $84,500 to $140,100. And then those in the top 20% are those earning above $140,100. And looking at this you're going to see that only one group today is paying more than it did 20 years ago. That is Ohioans making under $26,000 a year, the lowest those in the lowest 20%. And they will be seeing a tax increase of $32 in 2026. Middle income Ohioans only see small decreases. So for the middle three groups, the tax changes are pretty modest. And a typical middle income Ohioan saves a little bit more. Someone earning about the state's median income of $72,212 will see an average tax cut of about $459 a year. So that's about $38 a month. And the figure wanes when compared to the tax cuts received by the top 20%. This group is paying $8,697 less compared to what they were paying in 2005. And that is the top 20% taken together. And I want to zoom out and look at the top 5%. The top 5% of Ohioans are seeing massive gains, while middle income Ohioans are saving a few $100s. The wealthiest Ohioans are gaining tens and thousands of dollars annually from these cumulative tax changes. The highest income group, the top 1%, those earning over $753,000 annually are paying nearly $69,000 less per year than they did in 2005. So what does this look all together? What is the past table and this table? How does that kind of pan out? And the next slide kind of demonstrates what those tax changes look like. And it's pretty drastic. This big picture speaks loudly. The Ohioans with the most have been the winner of a majority of tax cuts put into place since 2005. All while the Ohioans with the least have received little to no benefits from these policy changes. And this impacts the service that everyday Ohioans and their communities depends on as well. Ohio cannot equitably fund crucial services and an infrastructure that everyday Ohioans depend on because our legislature has chosen to shift the responsibility for funding those resources from the wealthiest, those who can afford to pay more, onto low and moderate income families. Let's peek behind the curtain and explore how we got here. Next slide, please. To start this discussion, there has to be somewhat of an exploration of the difference between regressive and progressive tax policy. Regressive taxes hit low-income people harder, taking a larger share of their income relative to their ability to pay. Progressive taxes ask more of those who have more, ensuring higher income households contribute a greater share of their income. The difference is fairness. Regressive systems burden those with the least, while progressive systems align contributions with financial capacity. Next slide, please. And we can break down kind of this shift or this difference between progressive and regressive taxes by looking at the three kind of big tax groups we have in Ohio. Income taxes are the only progressive tax we have in the state of Ohio. They're directly tied to one's ability to pay. The sales and property tax tend to be regressive because they're not tied to your ability to pay. The income tax is also graduated, meaning that even though we'll get into it in a second, there's been a passage of a flat tax, it's still somewhat graduated. So it means that people with less income are not, seeing a disproportionate amount go to this. Let's move to the personal income tax changes. Next slide, please. So income tax cuts since 2005 have led to a loss of about $15.9 billion of revenue a year. Not all of the tax cuts are shared equally. Every income group receives some tax reduction on average, but the size of those cuts varies drastically. And you can see that the lowest income Ohioans see the smallest benefit. Those making under $26,000 a year receive an average tax cut of $131 annually, or about $11 a month, which is roughly enough for lunch once a month. And that depends sometimes on where you are as well nowadays. This group just receives 1% of the nearly $15.9 billion in total income tax cuts over the next 2 decades. The middle income Ohioans see modest savings. Typical earners making between $50,200 and $84,500 receive an average annual cut of $821, or about $68 a month. That's enough to cover part of a utility bill, and more than half of those savings are erased by other taxes. Even after 20 years of tax cuts, a median Ohioan does not gain enough to cover a single month of basic living expenses. Now, compare that to high-income households. They capture a vast majority of the tax cut dollars. The top 20%, so incomes over 140,000, see an average yearly cut of $9,172. This group claims 74% of all income tax cuts, leaving only a quarter for the bottom 80%. The top 1% see enormous windfalls. Ohioans earning over $753,900 a year take home an average tax cut of about $68,000. This tiny group alone captures a quarter of the $15.9 billion in cumulative tax cuts, enough to buy a new luxury SUV every year. While the bottom 80%, the vast majority whose income is under 140,000, split the same share as that top 1%. Over the next 2 decades, the 1% have gained a monthly tax cut of $5,583, larger than what the bottom 80% receive in an entire year. That's $3,259. And I want to talk about the history of how we got here, but first, let's briefly talk about marginal tax rates. Next slide, please. So I understand we have some tax experts in the room, so some of you may be very familiar with marginal tax rates, but I thought it's just worth quickly reviewing. So you can think about tax brackets as pockets in a sense, and your income as kind of those dollars that fill the pockets. And so let's say you make $101,000. So the first $26,050 of your income goes in the first pocket, and you pay $0 on that income. The remaining amount of your income, so your income above that $26,050, spills into the next pocket, and it fills up that pocket all the way up until it reaches kind of $100,000. And so that income between $26,051 and $100,000 goes in that second pocket, and you pay $342 and 2.75% of kind of the remaining amount on that. And then your remaining income goes into the very last pocket. So that is kind of that $1 if you're making $100,000. That's kind of what goes in that last packet. And you pay 3.25%. So you're not, if you're making, let's say, $100,001, you're not paying a 3.25% rate on the entire income. You're paying that rate on the $1 for that income exceeding $100,000. And so that's just to kind of give you some context in terms of how that works. And now we can kind of step into how tax rates have changed since 2005. Can we go to the next slide? So in 2005, we had 9 tax brackets. And you can kind of see that here. And it's a pretty complex kind of set of brackets, but it meant that those kind of earning, those with more were being taxed progressively as their dollars increased. And then we can go to the next slide. Then in 2025, so 20 years after this, we have 3 tax brackets. We have cut rates in almost every single budget that we've had since 2005. So in 2025, we had 3 brackets, and you might remember what happened with our budget that just passed last year. Next slide, please. We passed the flat tax. And so last year included the passing of the flat tax, which eliminated the 3.25% bracket on income over $100,000. And so what does that look like? What has that meant? Let's look at that. So the flat income tax does not benefit a majority of Ohioans. Low-income Ohioans get nothing. Ohioans earning under $26,050 receive no benefit at all. Ohioans earning under $100,000 receive no benefit at all because it only has slashed a bracket for people earning above that kind of $100,000. Millionaires benefit overwhelmingly from this tax plan. The move to flatten Ohio's tax income to 2.5% by 2026 this year will give the average millionaire a $19,000 annual tax cuts. That's more than 100 times the average cut received by non-millionaires. And the flat tax is a major driver of long-term revenue loss. Of the $17 billion of annual revenue loss generated by Ohio's tax changes since 2005, the shift to the flat tax accounts for a significant share. It alone will cost the state approximately $486.2 million in financial year 2026 and $1.3 billion in financial year 2027. And the result is a more regressive tax system. High income households gain the most, while low and moderate income Ohioans see little to no benefit, widening inequity and shrinking resources available for public services. Next slide, please. This was not a change made with like the most recent budget, but it's just something we also want to highlight. Another thing that has impacted income tax changes is the BID and LLC loophole. BID stands for business income deduction. We sometimes refer to it as the LLC loophole, so that's, I think, maybe more of a policy matters thing. But the LLC loophole gives substantial tax breaks to business owners, allowing many to pay no taxes on the first $250,000 of their business income. Income above that mark is taxed at only 3%. One of the interesting and weird quirks is that with the flattening of with the elimination of the 3.25% tax bracket, this has meant that this income is actually taxed a little bit higher, because it used to be that your income over 100,000 was taxed at that 3.25%, and this was taxed at 3%. But now this kind of income is actually taxed at a slightly higher rate. So it's just a fun, weird little quirk, but still it does cause revenue loss. Let's transition to the next one. I really want to emphasize that not all income tax cuts are bad. I know that kind of the majority of what we've talked through do not land and bring benefit to the lowest income Ohioans, but there's two things we want to focus on. Next one, please. First is bringing back bracket indexing. Bracket indexing adjusts tax brackets for inflation, so people with low income aren't pushed into a higher bracket just because of cost of living increases. Ohio has bracket indexing written into its constitution, but lawmakers have suspended it since 2023 and have recently voted to suspend it again for 2025 and 2026. Because of these suspensions, the income level at which Ohioans begin paying income tax, that's that $26,050, has remained unchanged essentially since I believe 2023, causing many working and middle class households to face effective tax increases despite little or no income growth. Next slide, please. And I want to provide an example of how exactly that works. A person who's paid $26,000 in 2023 was below the state's income threshold. They owed $0 in state income tax. Their income increased to $27,000 over the next few years, which is slower than the rate of inflation, but they would have crossed that minimum threshold for what they owed. And they would then owe the $342 plus the 2.75% on the $950 of income over $650, $26,050 above the taxable floor. With bracket indexing, the threshold would have increased enough that they would still be exempt, which would be a good thing because accounting for inflation, even with their $27,000, even $27,000 would pay having less spending power in 2025 compared to what $26,000 had in 2028. And so, they're getting this cost of living increase, but it's not something that they're actually being able to benefit from because we are not indexing for that kind of inflation. Next one, please. The other thing that we think is a progressive kind of income tax cut would be to make the EITC refundable. So the EITC is the earned income tax credit. And Ohio currently has a non-refundable EITC. And it reduces your tax liability to zero, but it does not provide a refund for any excessive credit. So for example, if you owe taxes and you have a non-refundable credit, your taxes become zero, but you lose kind of the remaining amount that you would get back. So it helps qualify low-income Ohioans to reduce their tax bill, but it doesn't benefit Ohioans that are exempt from those taxes. So if you're earning under the $26,050 and you're not paying any taxes, but you're kind of qualified for the ITC, I mean, you're still not paying taxes, but you're also not getting a benefit back that would actually help you and your household. Next slide, please. So now we're going to shift gears and talk about changes to sale, excise, and business taxes. Next one, please. And we're just kind of looking at this graph, and you can see that these changes have impacted every group. Taxes have gone up for every single group, and this one also includes kind of the 1% here. Next one, please. So Ohio has had to depend a lot more on these regressive taxes, in part because of a repeal of the corporate franchise tax and the tangible personal property tax. So that was repealed as part of HB 66, which was the budget bill that was passed in 2005. And the repeal of the corporate franchise tax, which was Ohio's corporate income tax, made Ohio one of just 6 states that levies no corporate income tax on profits. And in the place of these 2 taxes, legislators created the commercial activity tax. Next one, please. So first, I want to just talk about the difference between the corporate franchise tax and the tangible personal property tax. And so the corporate franchise tax is a tax levied on corporate income, is a corporate income tax levied on profits or net worth, and the tangible personal property tax is on local tax on machinery, equipment, furniture, inventory. And I think the easiest way to explain that is that property tax is kind of split into 2 categories. And if you were here for our last discussion, you might remember there's real property and then there's personal tangible property. So real property focuses on kind of land and buildings, and personal tangible property focuses on things that companies use to conduct their business. And so again, that's like machinery and equipment. And this being repealed kind of took away most of the groups that would pay this tax, with the exception of public utilities. Next one. So in its place, what we got was the CAT tax. The CAT tax is a tax on business gross receipts, and it's applied at a rate of 0.26% of Ohio's taxable gross receipts. Before tax year 2024, businesses owed the CAT tax if they had more than $150,000 in Ohio in taxable gross receipts. And then in 2024, the threshold increased significantly. So only businesses with, I'm going to call taxable gross receipts TGR over 3 million owed the CAT. Then in 2025, businesses paid no CAT on the first 6 million of their TGR, effectively eliminating the tax liability for most businesses. Most businesses fall well below this threshold. In 2023, 71.1% of Ohio filers had under 1 million in TGR. So you can see that as we've kind of expanded the threshold for when businesses have to pay, fewer and fewer businesses are actually having to pay this at all. Next one. And so according to the Ohio Department of Taxation, the CAT tax generated $2.39 billion in revenue in financial year 2025. Our partner, the Institute on Taxation and Economic Policy, estimated that for 2026, if the corporate franchise tax were still in place, it would have generated $3.8 billion in revenue. And if the business tangible personal property tax was still in effect, it would have generated $2.27 billion in revenue. So next one. And so we're only generating kind of a fragment of what we were generating before when we had these two other taxes. The legislature partially offset the revenue loss to business tax cuts by raising taxes on gasoline, sales, and cigarettes. And these changes draw out even more from those with the lowest incomes while coming up short. These tax changes generate an estimated 1.2 billion in revenue annually, while the business tax cuts alone costs the state $4 billion in revenue. And so simply put, after the legislature crafted HB 9 to allow businesses to pass on simply put, Ohio businesses pay little to nothing to support social and material infrastructure that allows them to thrive. And what they do contribute is in fact drawn from consumers by raising prices. And these prices are especially harmful to Ohioans with lower incomes. It was found that while we had the corporate franchise tax and the personal tangible property tax, about 17 to 19% of the cost of that tax was passed on to consumers. Once we moved to the CAT tax, and by the way, when I say consumers, I'm focusing on the lowest 60% of Ohioan earners. So that was like those first three quintiles. After the passage of the CAT tax, the amount that was passed on from this tax onto consumers jumped up to 30%. And so as you can see, it almost doubled in a way how much businesses passed on the price of like a corporate tax onto consumers. So please. And so now we're getting to the cost and consequences. We do not have this revenue, and we've seen these tax cuts. Have they led to the promises that we were told that they would bring? Job growth and GDP growth. So as you can see from this graph, since the passage of these bills since the passage of these cuts since 2005, these multiple years of cuts have not really helped Ohio's economy. Job growth is slower in in Ohio compared to the United States in almost every single year since the cuts have started in 2005. Next one. And Ohio's economy has grown slower than the US in all but 4 years since 2005. And so you have the wealthiest Ohioans paying less in taxes since they did in that year, while poor Ohioans are seeing their bills in some cases go up or decrease very modestly, all while Ohio's economy, its infrastructure, and its resources have not really benefited. Next one, please. Okay. And so we've gone through the story of what we've lost in terms of our income tax and our sales tax and changes to our corporate tax. And it's about $17 billion of lost revenue. If we were to have this revenue, we need to think about what we could do with it, the services we could fund, and what we could do to ensure that Ohioans actually have a state and community that they can be proud of and can live in and thrive. And so with these taxes, we could fund the Fair School Funding Plan. So every school can meet students' needs. We could increase support for publicly funded childcare to expand access and improve affordability, ensuring that ensure fair wages for early childhood educators. We could expand Medicaid eligibility for pregnant women and children up to 300% of the federal poverty line. And we could provide targeted tax relief, such as the circuit breaker, the refundable EITC, while preserving revenue for essential public services. And so I think what I would like folks to take away from this is that this has kind of been a trend since 2005, these types of tax cuts. And this isn't really a trend that is slowing down. This report does not capture the changes that have been very recently made to property taxes as well. And there's some other taxes we don't capture. But we are still seeing this kind of trend of tax cuts within the state. And all while we're seeing educators, childcare providers and libraries and those sorts of services wonder where they're going to find this, where they're going to find the money to continue to provide quality services for Ohioans. And so it's necessary that we look at our tax system and ensure that it is changed in a way that asks more from those who can provide more or those who can afford to pay more and actually take care of Ohioans with the least. And that is 100% possible. This is something we're going to be looking at in our next few series. The next Revenue Roundtable we'll be having, we'll be looking at tax expenditures, which is a fancier word for tax cuts, but some of the tax cuts that we put into place since 2005 and looking through who they have benefited, if they've had the intended impact, and then making suggestions for some that we should eliminate to preserve revenue. And then future sessions will also be looking at tax policies that we could implement to raise revenue in a way that is progressive. I hope you join us for that, and I really hope you've enjoyed this presentation. My one final note is that if you remember the first slide, that was the $17 billion of lost revenue. That $17 billion of lost revenue is huge, but it doesn't capture all of the efforts made by groups across Ohio to preserve revenue, and it could have been much higher. And so it is a large number, but there has been a constant effort by groups and advocates across Ohio to make sure that these policies do face criticism and they are not, as bad as they can be. And so now I want to just leave room for questions.